China wasn't always the world's manufacturing powerhouse. In fact, its journey to becoming the world's factory is a tale of transformation and strategic evolution. For much of the 20th century, it was a closed, agrarian society with a centrally planned economy. The landscape was dominated by vast farmlands and small villages, where traditional farming was the way of life. Everything changed in the late 1970s, when Deng Xiaoping launched sweeping economic reforms, famously declaring, "To get rich is glorious." This marked the beginning of a new era for China. China opened its doors to foreign investment, creating special economic zones like Shenzhen, experimental hubs for capitalism. These zones became the testing grounds for new economic policies. Foreign companies flocked in, attracted by tax breaks, fewer regulations, and access to China's vast, low-cost labor force. This influx of international business was unprecedented. Millions of rural workers migrated to booming cities, eager for factory jobs that paid more than farming. This migration fueled the rapid industrial growth. Western corporations saw an irresistible opportunity: cheap, diligent labor and massive production capacity. They quickly set up operations, integrating China into their global supply chains. China quickly became the go-to destination for manufacturing everything from toys to electronics. Its factories churned out products at an astonishing pace. The turning point came in 2001, when China joined the World Trade Organization. This pivotal moment opened up new avenues for trade and economic expansion. This gave China access to global markets and unleashed a flood of affordable Chinese goods worldwide. The Made in China label became ubiquitous. Foreign investment soared, and factories multiplied at an astonishing rate. The industrial landscape of China transformed dramatically. China was no longer just participating in the global economy, it was becoming its central hub. Its influence on global trade was undeniable. The stage was set for an economic transformation unlike any the world had seen. China's cities grew, and its economy flourished. The world's factory was born. China's rise as a manufacturing giant reshaped the global economic landscape, setting new standards for production and trade. After joining the WTO, China's manufacturing power hit its peak. Made in China labels became universal, found on products everywhere. Entire cities specialized in making socks, lighters, or buttons, creating unmatched efficiency. China's GDP soared, lifting hundreds of millions out of poverty and building a new middle class. Skyscrapers rose in cities like Shanghai, symbolizing newfound wealth. China built the world's longest high-speed rail network and massive infrastructure. The world benefited, Western consumers enjoyed low prices, and corporations reaped higher profits. The model was simple: massive scale, low wages, and strong government support. The government offered subsidies, cheap land, and invested heavily in infrastructure. Each new factory strengthened supply chains, attracting even more investment. China became the undisputed workshop of the world. For a time it seemed this win-win model would last forever, but change was on the horizon. No golden age lasts forever. As China grew wealthier, labor costs rose and factory workers demanded better pay. The once endless supply of cheap labor began to shrink, thanks in part to the one-child policy. Fewer young people entered the workforce, creating shortages and driving wages higher. Many young Chinese now seek jobs in tech or services, not factories. The old model, low-cost, high-volume manufacturing, was losing its edge. China was becoming too expensive for low-margin production. The country's own success was making its original formula obsolete. Both the government and global corporations realized the system had to change. The cracks in the world's factory were impossible to ignore. The era of cheap, abundant labor was ending. A new chapter was about to begin. As China's costs rose, companies searched for alternatives. Vietnam emerged as a top choice, offering lower wages and a business-friendly government. Major brands like Samsung and Nike built massive factories there. The China Plus One strategy took hold: diversify by adding production in Vietnam, not abandoning China entirely. Vietnam's proximity to China's supply chains made this shift easier. India, with its huge young workforce, also became attractive. The Indian government pushed its Make in India campaign, luring manufacturers with incentives. Apple and others ramped up production in India. But neither Vietnam nor India can yet match China's infrastructure or deep supply chains. For now, they're chipping away at China's dominance but not replacing it. The global manufacturing map is starting to shift. In 2018, economic pressures and political ambitions collided dramatically when the United States launched a sweeping trade war against China. This marked a turning point in global commerce. as two of the world's largest economies clashed over tariffs and trade policies. Suddenly, tariffs made Chinese goods more expensive for American consumers and businesses, undermining China's long-standing cost advantage and shaking up established trade flows that had defined the previous decades. Companies around the world scrambled to rethink their supply chains, accelerating the China Plus One strategy, seeking alternative manufacturing hubs in countries like Vietnam, India, and Mexico to reduce their reliance on China. Even as new U.S. leadership took office, the tough stance remained. Tariffs and technology restrictions continued, signaling that the trade war was not just a temporary policy, but a new normal in U.S.-China relations. The U.S. now talks openly of de-risking, a strategy focused on reducing dependence on China for critical goods and technologies, and building more resilient supply chains. This climate of uncertainty forced companies to plan for potential geopolitical shocks, investing in risk analysis and crisis management like never before. For China, the trade war exposed the dangers of relying too heavily on exports, especially to the U.S. market, and highlighted vulnerabilities in its economic model. Beijing responded by trying to boost domestic consumption and encourage innovation, but shifting from an export-driven economy to one powered by internal demand is a slow and challenging process. The trade war left a lasting shadow over global trade, disrupting established routes and creating new uncertainties for businesses and governments worldwide. China's reputation as a stable, reliable manufacturing base took a significant hit as companies and investors began to question the risks of concentrating production in one country. The world's factory was now facing not only economic headwinds, but also growing political challenges and environmental scrutiny. The rules of global trade had changed, ushering in a new era of competition, caution, and adaptation for nations and businesses everywhere. China's rapid economic growth over the past few decades was fueled by an unprecedented wave of borrowing and investment. The government, state-owned enterprises, and private companies all took on massive amounts of debt to build sprawling new cities, modern factories, and vast networks of infrastructure, roads, railways, and airports that transformed the country almost overnight. For years, this debt-driven growth seemed unstoppable, powering China's rise to the world's second-largest economy. But eventually the pace slowed, and cracks began to appear. The real estate sector, once the engine of prosperity, became a major liability. Across China, empty ghost cities stand as stark reminders of overbuilding, while giant developers like Evergrande teeter on the brink of collapse, unable to pay their bills. Local governments, having borrowed heavily to fund ambitious projects, now find themselves struggling to repay loans, with many public works left unfinished. If defaults begin to spread through the financial system, China could face a crisis reminiscent of the 2008 meltdown in the United States, sending shockwaves through the global economy. Economists and financial experts warn that China's current level of debt is unsustainable, and the risks are mounting with each passing year. The government is now trying to rein in borrowing and reduce debt, but it must do so carefully, without triggering a sharp slowdown or even a recession. It's a delicate balancing act that requires precise timing and policy. Move too fast, and economic growth could stall, leading to job losses and unrest. Move too slow, and the mountain of debt continues to grow, increasing the risk of a sudden financial shock. The debt crisis now threatens not just the real estate market or a few companies, but the stability of China's entire financial system and the livelihoods of millions. Managing this enormous mountain of debt is one of the most complex and urgent challenges China has ever faced. The stakes couldn't be higher, for China and for the world. China's economic troubles have deep political consequences. The Communist Party's legitimacy depends on rising living standards. Slowing growth threatens this social contract, especially with high youth unemployment. A weaker economy could fuel unrest and limit China's global ambitions. Beijing must choose fund military and global projects or address domestic woes like jobs and housing. Some fear a struggling government could turn more nationalistic or aggressive abroad. The stakes for China and the world are enormous. China stands at a crossroads. The old world's factory model is broken. The challenge now, can China reinvent itself as a leader in high-tech and advanced manufacturing? The government's Made in China 2025 plan aims to dominate robotics, AI, and electric vehicles. Companies like BYD and DJI show early success, but US tech restrictions are a major obstacle. Internal problems, debt and demographics also threaten progress. The future of manufacturing will be more fragmented, with low-end production shifting to Vietnam, India, and beyond. China will fight to keep complex manufacturing and push into tech. The era of one undisputed world's factory is ending. China's manufacturing power must evolve to survive. The next chapter is just beginning.